Okay, so let's move on to the second half of the slides. Free cash flow valuation model. Okay, so why do we need this alternative model? Well, very important. As nice and powerful as the discount model, a discount dividend model can be, actually the dividend is not issued in every single stock. So there you go. What if you don't, if you have it on hand to evaluate and that stock is not paying any dividend? Well, of course, you will have to find something else. Okay, so that something else is oftentimes the free cash flow here. And again, as a review, the free cash flow is the cash flow available for distribution to all of a company's investors. So this is actually what you calculated before the interest payment, because the interest payment is also a part of the free cash flow. So, and the second concept of free cash flow is that it has to be generated by a company's operations. So it cannot be the investment. So if you are, for example, if you are Toyota car company, okay, so it has to be something generated by your car-related business. Well, you could potentially put a lot of money in Goldman Sachs, and they can manage your fund and get a lot of profit for you, but that is not your free cash flow. Okay, so you want to focus on the main operational part of the company. The weighted average cost of capital and is the overall rate of return required by the company's all investors. Remember, we have the company's part of the financing coming from equity, and part of it coming from the fixed income or the bonds. So it's easy to understand that the bonds or the fixed income has a cost of debt, because it's easy to understand that you have to pay, because you have to pay an interest rate on all your debt, right? If you take on a mortgage, you will have to pay mortgage rate and mortgage interest on it. However, it's oftentimes people don't understand why the stocks also requires a certain kind of return. Well, the rationale here is that whatever the investors are requiring is actually what the cost of the company to get that. So if you as Apple stockholder, you are actually earning 20% of return, and that's 20% that could be potentially enjoyed by the company. It's the company's growth 20%. And that's why by giving that 20% to you as a stock owner, this company is actually paying the price of its financing. So if you understand it this way, you understand that they are paying a price on both sources of financing. And if you take a weighted average, that's what we call the weighted average cost of capital. Okay. So the detailed way of calculating weighted average cost of capital, we will cover later in the semester. So don't worry, bear with me. Right now, just assume that the WACC weighted average cost of capital is a known number. Okay. Let me put this on hold for a little bit. Okay, sorry for the interruption. So let's continue. The value of operations. Basically here, the WACC, the weighted average cost of capital, is used to discount the free cash flow so that we can arrange to eventually achieve the value of operations. So what's the rationale? Again, the idea of evaluating anything on the sum of a present value of cash flow that it can generate. So here in this case, if we think about the company as just carve out any extracurricular activity, okay, just throw away those investments and things like that, but just focus on the company's operation part. And then the free cash flow that we argue is everything that this company can generate through its operation. So the free cash flow is the stream of cash flow that's generated by the company's operations. Therefore, the value of the company's main operation should be the sum of the present value of all the future free cash flows. So with that kind of rationale, we put out the same structure, same framework with this discounted cash flow, except for we use free cash flow as the cash flow part, and we use weighted average cost of capital as the discount rate. Okay, so the source of the value, some part of it, again, can be coming from the marketable securities, so they can hold other companies' stocks and bonds and things like that. And they can come from the ownership of non-controlling interest. So basically, you can earn, say, 30%, 20% on another company, although it's probably not going to be marketable, immediately sold, but still it is a form of holding a part of other company. And these are the kind of non-operating assets. Okay, so with all the value of the firm's corporation operations, who are the ones are going to claim on it? So first of all, the debt holders, they can have a claim. Remember, the free cash flow includes the money that you're going to pay to the debt holders. So the debt holders potentially owns a part of that value, right? So the debt holders definitely have a claim on it, and they also have the first claim because their claim has to be satisfied before the equity holders are going to come have a part. And then the preferred stockholders comes before the regular or common stockholders. And then any remaining value belong to the stockholders. So what are we going to do? We're going to calculate the firm's value, the firm's overall value, and then carve out the debt value, which is the amount that can be claimed by the debt holders. And then we are going to carve out the preferred stock value, which is the part that claim from the preferred stockholders. The rest of the value will be the equity value. So this is the second route of evaluating stock. So basically, we calculate the firm's main operation value, take away the debt value, take away the preferred stock value, and the rest of it is equity value divided by the shares outstanding, then you get the per share value of equity. Okay, so here the free cash flow is equal to 24 million, and weighted average cost of capital, WACC, is 11%, and it's expected to grow at a constant rate of G equal to 5%. Marketable securities 100 million, debt 200 million, preferred stock 50 million, number of shares 10 million. So how are you going to do it? Okay, first step first, we are going to calculate the value of operations. So we're going to take the free cash flow, the last free cash flow, times 1 plus G to get the free cash flow next, free cash flow 1, okay? Divided by, now this time the required rate of return is replaced by WACC. So you take WACC minus G here, Okay, it's 24 million times 1 plus the 5%, divided by the 11% WACC minus the 5% growth. That's 420 million. So this is the firm's value of operations. Okay, you take that value and plus the short-term investment, whatever holding other kind of alternative, other kind of values, those are supposedly a lot easier to evaluate. So in this particular case, the problem has already told you that it's 100 million. So you just add that part in there. So then we get the total value of a company is 520. Now we start to use the 520 and subtract the debt value 200 million, subtract the preferred stock 50 million. The rest of it is the value of the equity. So you take the total value of equity, divide by the 10 million outstanding, you get $27 per share. So this is the rationale of evaluating the stock price through the free cash flow, through discounted free cash flow. Okay, so similar to discounted dividend method, we can also have a high growth rate in the following years and a long run lower growth rate in the future. Okay, so for example, we can have a projected free cash flow here. The first year, you're actually going to be negative. You can lose money. Second year, you can have 20 million. Third year, you can have 35 million. So here, I'm not even telling you the growth rate. I'm just telling you what the free cash flow will be, which is even easier. Then after the third year, it's going to grow at a constant rate of 5%. So in this case, how are you going to calculate the operations value? Well, the first step is that you are going to calculate the horizon value. Yes, that's right. Horizon value. Okay. The horizon value is going to take free cash flow in the last year, not the last year, the third year. Okay, negative 10, 20, 35. Okay. Or sometimes we call it a continuing value. So we get the third free cash flow, which is $35, multiplied by the long run growth rate 5%, and then divide by the WACC 11% minus the 5%. You're going to get 612.5. Okay. Then you take that and add it on to 35. The second year is 25. The first year is 10. So if we calculate, if we put it in the calculator real quick, let me share application here. Okay. Make it a little bigger. So we can have what the first cash flow is. The first cash flow, see if the initial outlay is 0. The CF1 is equal to what? I don't remember. Negative 10. The second cash flow is equal to 20, and third cash flow is equal to 35, and then the horizon value is equal to 612.5, right? So we're gonna press it into the cash flow button, and then press the second clear button, and then we are going to calculate. We're gonna press 0, enter, go down arrow. I don't know how to write it in Word, but then we get CF1, and when you see the F01, you put it in 1, keep it in 1, enter, down arrow. Kind of have to add it after every single move. Once you know it, you know it. Okay, so in the last one, however, you're going to have this one plus 612.5. Enter, downward arrow. Okay, so then again, F0. So F03, F02. So second cash flow 20, then repeat for once. Third cash flow 35 plus 612.5 equal to what, 647.5. Enter, downward arrow, and the last repeat also once. And then you want to press the button MPV. Okay, it'll ask you for the interest rate, put in the 11%, and then go down, and then MPV. Okay, so compute. So that should give you the whole correct number. Okay, so let's come back. I'm sharing the file. And come on. Okay. This is what we saw. And eventually you should get a number that is very, very close to 480.67. Okay, so that was the step number 1. Remember, we have several steps to go. Step number 1, calculate the value of operations. Step number 2, we need to add on to it any kind of short-term investments. Okay, in this case, 100 million. And then we are going to subtract the debt and subtract the preferred stock. Remember, it's the same setting as the previous example, except for here we have a different kind of growth trajectory. Instead of a constant growth, we're going to have a very high free cash flow in the first several years. Well, actually, the first one is negative. But like, let's say, irregular free cash flow in the first several years, and then going on a constant growth in the future. Okay, so in this case, the price that you eventually get is 33.07. Okay, a quick comparison of free cash flow model and dividend growth model. The dividend growth model is nice. It relies on the assumption that anything the firm actually earns will eventually go back to you, right? So in a certain form, if they're not paying dividend right now, it just means that they are not, they think reinvesting in their own firm is gonna earn a higher return than paying the dividend to you. So They're usually the higher growth firms. But here, if they don't pay any dividend, then you can use the free cash flow model, and you use the free cash flow model whenever they have, see the whenever you see a privately held companies has not paid dividend. You can look at the divisions of companies, which is probably not going to be traded publicly. So it kind of helps for you to understand what each part of the company is going on. Okay, and companies that pays zero dividends or very low dividends, these are three main usage of the free cash flow models. However, the free cash flow requires a forecast of financial statements to estimate the free cash flow. That's the hard part. The dividends, as irregular as it sounds, actually most of the firms try to keep it stable. They try very hard. That's another topic actually in finance, is because the dividend is not only going to reflect the periodical operational profit, but also have a strong signaling effect in the market. So you lower the dividend and the whole market will read it as a negative signal, and as the lack of confidence for the company's management to be able to maintain this level of dividend. That's why you lower it. That's why you drop it down. So in order not to send such a bad signal to the market, most of the people will try to maintain a very steady growing dividend. And that's why the discounted dividend model actually has its merit most of the time. Okay, so if you're using the stock price multiplier, the third method is to use stock price multiples to estimate the stock price. So the first method, dividend discounted model. The second method, free cash flow model. And third method is the stock price multiples. And this one we actually did in the first 2-3 chapters when we learned all those multiples, when we talk about the market ratios and then the PE ratios, and so this is a variation of that. Okay, so we oftentimes use, the most often used is the PE ratio, PE multiple, the price per share divided by the earnings per share. So for example, you estimate the average PE ratio of comparable firms, and then multiply the average PE ratio by the expected earnings of the company to evaluate its stock price. Okay, you can also use entity multiples. The entity value in that case is the market value of the equity. So number of shares of stock multiplied by the price per shares of stock plus the value of the debt. So this is arguably the entity value. Okay, so you can pick up any kind of a measure like EBITDA, sales, customers, eyeballs, and calculate the average entity value for a sample of comparable firms. So you can pick up like entity value divided by EBITDA, entity value divided by number of customers, for example, and then you calculate the ratio for these ratios for a small sample of comparable firms, 4 or 5 maybe, and then use that average to calculate this particular firm's entity value. Okay. And find the entity value of a firm in the question. So using the average ratios multiplied by the measure that you're going to use, you get the entity value, and take away this firm's debt, and to get the total value of this equity, and divide by the number of shares. So that's how you do an entity multiples. So the problem with market multiples is that, first of all, it's hard to find comparable firms. I mean, every firm has a different situation. How are you going to say, okay, I'm going to be similar to you, right? So unless it's a very stable market that has multiple companies that has approximately the same size, the same management, the same structure, which is unlikely. So you can only have a ballpark kind of. And even if you manage to find the comparable firms, those values can go like wild. It can be from 1 to all the way to say 10, 50. So, and you will be lost. You'll be like, oh, they're not even that close. So does the average really make any sense? Okay, so these are the difficulties we see with the market multiple methods. Basically, the data can be messy. Okay, so before we get into the preferred stock, which kind of mentioned in the end of last video, I want to quickly comment on this second case that you're going to start today. So the second case, oh yeah, sorry, the term paper, hopefully you have already started, that you are going to evaluate a firm. So in order to evaluate a firm, you will need to do all these different analyses. So I want you to go into the market and analyze this firm's overall background. And first of all, attack everything using the ratios and to see how their internal operational value is doing, which is kind of the stuff you do in case number 1. And second of all, evaluate the external market condition. So using the part that you're doing in the second case, look at the overall market returns and CAPMs and things like that to calculate the required rate of return, to calculate WACC. Okay, WACC we'll learn later on. And then with the required rate of return figured out, or the beta and everything, I want you to use the stuff you learned in this particular chapter today to evaluate a firm using 3 different methods: discounted dividend model, using the free cash flow model, the market multiples. And that should be a pretty comprehensive report to make. And lastly, as we mentioned briefly before, preferred stock. Okay, so it's hybrid security, similar to bonds, but not having the legal right to push through bankruptcy, so not as high a priority compared to bonds. And then since it's going on to forever, in that sense, it's similar to dividends, stock dividends. Is going to be evaluated as simple as taking the dividend divided by the periodical interest rate. So if it's annual dividend 2.1, then you use annual rate. If it's semi-annual rate, if it's semi-annual dividend, you use semi-annual rate, so on and so forth. Okay. So as usual, you will go through the end of chapter questions, and I'm going to assign you a task of putting in, you will need to assignments. Post one problem on the Blackboard forum and answer. It's like a post one problem solving kind of problem, and then post one question, and then you want to solve one problem from your classmates. And answer and discuss, or discuss, comment on one question posted by your classmates. Okay, so align these nicely. And these are going to be done by the end of Monday. So I'll make the forum open, and have fun watching my video, and hopefully see you next Saturday. Tell me how it feels.